Welcome to the fourth session of the Account Double, Any Trouble? Thank you for listening and watching today's session. I know you are busy people, you got jobs, you got families to take care of, and just to know that you are taking a little bit of time out of your day to listen to me just makes me so happy. So thank you. Let's start. In today's session I'd like to cover 3 points. Firstly, recording a general journal entry. Secondly, posting to general ledger accounts. And finally, preparing a trail balance. In today's presentation I'd like to explain the first 3 steps in the accounting cycle. Give and describe several examples of source documents. Explain the purpose of journalizing. Apply information from source documents. Describe the steps to make a general journal entry. Make general journal entries. Correct errors in general journal entries. Describe the steps in the posting process. Post general journal entries. Prepare a trial balance. Locate and correct trial balance errors. Record correcting entries in the general journal. As you can see, here are key terms: accounting cycle, general journal, journalizing, general ledger, ledger account forms, posting, proving the ledger, trial balance. To begin with first point of our session, recording a general journal entry. Let's take a look at accounting cycle. The accounting period of a business is separated into activities called the accounting cycle. These activities help the business keep its accounting records in an orderly fashion. You will have covered the entire accounting cycle for a service business organized as a sole proprietorship. Take a look at figure, which describes accounting activities and their sequence. First step, collect and verify source documents. Second step, analyze each transaction. Third step, journalize each transaction. Fourth step, post to the ledger. Fifth step, prepare a trail balance. Sixth step, prepare a worksheet. Seventh step, prepare financial statements. Eighth step, journalize and post closing entries. Ninth step, prepare post-closing trail balance. So, that's overview of accounting cycles. Now let's move on to first step. The first step in the accounting cycle is collecting and verifying source documents. The business owner, accountant, or accounting clerk, depending on the size of the business, uses source documents generated by business transactions to keep the records of the business. The accounting cycle starts by collecting and verifying the accuracy of source documents. One important activity is to check the arithmetic on each source document. Most business transactions take place during the daily operations of a business. In the course of one day, a business may pay its rent, place an ad in a local newspaper, contract to have a website created, pay its employees, sell products, and purchase new equipment. When a business transaction occurs, a paper is prepared as evidence of that transaction. This paper is a source document. There are several types of source documents that can be prepared by hand, by computer, or by a machine. The type of source document prepared depends on the nature of the transaction. Take a look at invoice. Lists specific information about a business transaction involving the buying or selling of an item on account. The invoice contains the date of the transaction, the quantity, description, and cost of each item, and the payment terms. Take a brief look at receipt. A record of cash received by a business. It indicates the date the payment was received, the name of the person or business from whom the payment was received, and the amount of the payment. Here we can see check stub, a part of a check that is kept for record-keeping purposes. For example, the stub is the part of a payroll check that includes information about the current paycheck as well as payments to date. The check stub can also be a carbon copy of a check that is made when the original check is written. The check stub lists the same information that appears on a check: the date written, the person or business to whom the check was written, and the amount of the check. Let's continue with the second step in the accounting cycle, analyzing business transactions. After collecting and verifying source documents, The second step in the accounting cycle can begin with analyzing information on the source documents to determine the debit and credit parts of each transaction. You have already learned how to analyze business transactions using the rules of debit and credit. Next, I'd like to take a look at next point of our session to general journal. Return to accounting cycle. Let's continue by looking at the third step in the accounting cycle, recording a general journal entry. You are now ready to apply information from source documents. The third step in the accounting cycle is to record the debit and credit parts of each business transaction in a journal. A journal is a record of the transactions of a business. Journals are kept in chronological order, that is, the order in which the transactions occur. The process of recording business transactions in a journal is called journalizing. Keeping a journal can be compared to keeping a diary in which all important events are written. A journal is the only place where complete details of a transaction, including both the debit and credit parts, are recorded. The journal is sometimes called the book of original entry because it is where transactions are first entered in the accounting system. The process of recording a transaction in the journal is called journalizing. The entry in the journal is called a journal entry. Now I outline the accounting period. What are the different types of accounting periods? As discussed earlier, accounting records are summarized for a certain period of time, called an accounting period. An accounting period may be for any designated length of time, such as a month, a quarter, or a year. Most businesses use a year as their accounting period. An accounting period of 12 months is called a fiscal year. If the fiscal year for a business begins on January 1st and ends on December 31st, it is called a calendar year accounting period. Many businesses start their accounting periods in months other than January. For example, department stores often have fiscal years that begin on February 1st and end on January 31st of the following year. School districts usually have fiscal years that begin on July 1 and end on June 30th. Moving on the next part, I'd like to explain journalizing. Using the rules of debit and credit, transactions are initially entered in a record called a journal. In this way, the journal serves as a record of when transactions occurred and were recorded. This transaction is recorded in the journal using the following steps. Step 1. The date of the transaction is entered in the date column. Step 2. The title of the account to be debited is recorded at the left-hand margin under the description column, and the amount to be debited is entered in the debit column. Step 3. The title of the account to be credited is listed below and to the right of the debited account title, and the amount to be credited is entered in the credit column. Step 4. A brief description may be entered below the credited account. Step 5. The post. Ref. It means posting reference, column is left blank when the journal entry is initially recorded. We will use this column later in this chapter when we transfer the journal entry amounts to the accounts in the ledger. The next slide shows method for analyzing and journalizing transactions. The following is a useful method for analyzing and journalizing transactions. Step 1. Carefully read the description of the transaction to determine whether an asset, a liability, an owner's equity, a revenue, an expense, or a drawing account is affected. Step 2. For each account affected by the transaction, determine whether the account increases or decreases. Step 3. Determine whether each increase or decrease should be recorded as a debit or a credit, following the rules of debit and credit. Step 4. Record the transaction using a journal entry. Moving on to the next section. Let's take a look at business transaction. Business transaction 1. To illustrate, we use the November transactions of Net Solutions. Chris Clark's first transaction, on November 1st, was to deposit $25,000 in a bank account in the name of Net Solutions. The effect of this transaction on the balance sheet is to increase assets, cash, and owner's equity, Chris Clark Capital, by $25,000. Business transaction 2. Net Solutions paid $20,000 for the purchase of land as a future building site. Analysis: this transaction increases one asset account and decreases another. It is recorded in the journal as a $20,000 increase, debit, to land, and a $20,000 decrease, credit, to cash. Let's continue with business transaction 3. Net Solutions purchased supplies on account for $1,350. This transaction increases an asset account and increases a liability account. It is recorded in the journal as a $1,350 increase, debit, to supplies, and a $1,350 increase, credit, to accounts payable. Business transaction 4. Net Solutions received cash of $7,500 from customers for services provided. This transaction increases an asset account and increases a revenue account. It is recorded in the journal as a $7,500 increase, debit, to cash, and a $7,500 increase, credit, to fees earned. Now, let's move on to business transaction 5. Net Solutions incurred the following expenses: wages, $2,125, rent, $800, utilities, $450, and miscellaneous, $275. This transaction increases various expense accounts and decreases an asset, cash, account. You should note that regardless of the number of accounts, the sum of the debits is always equal to the sum of the credits in a journal entry. It is recorded in the journal as an increase, debit, to wages expense, $2,125, rent expense, $800, utilities expense, $450, miscellaneous expense, $275, and a decrease, credit, to cash, $3,650. Business transaction 6. Net Solutions paid creditors on account, $950. This transaction decreases a liability account and decreases an asset account. It is recorded in the journal as a $950 decrease, debit, to accounts payable, and a $950 decrease, credit, to cash. Take a look at business transaction 7. Chris Clark determined that the cost of supplies on hand at November 30th was $550. Net Solutions purchased $1,350 of supplies on November 10th. Thus, $800, $1,350 minus $550, of supplies must have been used during November. This transaction is recorded in the journal as an $800 increase, debit, to supplies expense, and an $800 decrease, credit, to supplies. The next slide shows business transaction 8. Chris Clark withdrew $2,000 from Net Solutions for personal use. This transaction decreases assets and owner's equity. This transaction is recorded in the journal as a $2,000 increase, debit, to Chris Clark, drawing, and a $2,000 decrease, credit, to cash. Moving on the next section, let's take a look at posting to the general ledger account. Posting to general ledger accounts. What is a general ledger accounts? You learn to analyze business transactions and enter those transactions in a general journal. In this section you will learn to post journal entries to the general ledger and to prepare a trial balance. Posting is the process of transferring information from the journal to individual general ledger accounts. Recall that the accounts used by a business are kept on separate pages or cards in a book or file called a ledger. In a computerized accounting system, the electronic files containing the accounts are still referred to as the ledger, or the ledger accounts. In either system the ledger is often called a general ledger. The general ledger is a permanent record organized by account number. Posting journal entries to the ledger accounts creates a record of the impact of business transactions on each account used by a business. After journal entries have been posted, a business owner or manager can easily find the current balance of a specific account.